Welcome to the Techno Fundamental Report for May the 15th. We'll be doing the report a day early this week. Andrew Mellon. I just finished reading, I'm actually reading two books right now. One by John Kennedy called Profiles in Courage, and the other book is called Mellon, which is the autobiography of Andrew Mellon. Both books very interesting. Kennedy's primary purpose of writing Profiles in Courage was to talk about how difficult it is to be a senator. Now, he wrote the book while he was senator. And basically, Profiles in Courage was about courage, being a politician that has courage to say no. Now, Andrew Mellon wasn't a very popular guy. He was very frugal. He was Scotch-Irish, very frugal. And he wasn't really cared too much for by the politicians, especially Franklin Roosevelt during the New Deal, because Mellon was very big on frugality, and small government is good, big government is bad. Big government means more taxation. And so Mellon was an interesting leader for his time. He said here in this quote, he says, "If the spirit of business adventure is dulled, the country will cease to hold the foremost position in the world." So he was basically saying we've got to stay strong. So the reason I'm bringing this up is, and I think this is a story to be told, we've got a deficit, a federal deficit, and this is basically a projection of including inflation of the deficit. Now, it all started back here. World War I, we had a deficit. Then during the Franklin Roosevelt years, we incurred a deficit for World War II. Continued, but look where we are today. We are now at government spending, inflation adjusted, since 2020, now exceeds the combined spending of World War I, World War II, and the 1970 to 1990 time period. So we've got to have politicians that know how to say no, because we have a spending problem here. This is deficit spending. Now, if you take another look at interest payments on the debt, these are the projections. If U.S. Treasury interest payments, this is our current picture, projected assuming rates stay stable, we go to 1.6 trillion. And now this is for the interest payments only, 1.6 trillion if rates stay stable. However, if the Fed cuts rates by 1.5 points or 150 basis points, we see a 1.2 trillion in interest expense. We've got to say no. It's just reality hitting us square in the face. Back when Ronald Reagan was president, he came up with something called the misery index, which is basically the calculation is the CPI, which is inflation, plus the unemployment rate. Now, if you go back to the 1970s, you can see that we were really in pretty bad shape on the misery index. That's why Reagan got elected. Today, it's not as bad. I mean, we really do have a very vibrant economy. We have, low unemployment. Inflation is not running out of control like double digit. But we better get the debt under control, because this will be an ongoing problem. I'm reading another book, I just finished this book. This is Jesse Livermore's Methods of Trading in Stocks by Richard Wyckoff. Very good. It's a picture of Jesse Livermore, a very nice picture of him. Essentials to stock market success are knowledge and patience. Now, I want to emphasize the word patience. This is not get rich. The stock market, if you're looking to get rich quick, it's not the place to look. So few people succeed in the market because they have no patience. They want to get rich quickly. I think that's very, very insightful. I have a regular card game I play with friends, and we play gin rummy. And this is a perfect gin rummy hand. I mean, if you got this hand, you're really in good shape. But risk management is, we're focused investors, which means that we usually don't go over 10 stocks. We try to hold about 10 stocks. Well, if you notice in a gin hand, you've got 10 cards. And with risk management, there's really two ways to handle risk management. One is extreme diversification, which I'm opposed to. The other is focus investing, but then you have to be, very ready to manage the risk. In other words, if this hand was, let's say you had one king and you had two aces, you would want to discard that king and try to get, off the deck or from your opponent, ace. In other words, you always want to improve your hand. So when you're managing your stock portfolio, you don't want to be complacent. If you got a problem in the portfolio or something's too risky, such as that one king, you want to get that stock out of your portfolio and continue to focus on the strongest companies. So let's take a look at the market. Things are improving. We've gotten a real nice snapback here. It looks like confidence is building. If you notice here, the volume came in yesterday very nicely. NASDAQ making an all-time new high on very good volume. Our trend meters in the green, and so forth and so on. So the NASDAQ is looking very, very positive. S&P, same story. Snapback, back above the moving averages. You should be adding to your portfolio right now. We went through this correction. Now, one thing about corrections to understand is it's more than just the fact that the indexes have pulled back and things are down. But usually they're down for a reason, and the reason is that's a change of leadership. And we're going to see that here with some of the stocks we're going to look at. Now, I did want you to note the small caps are about to hit a new high here, and we're looking much better there. We had good volume. We're back in the green on the trend meter. So the thing about the small caps is this is a risk-on index. So in other words, if it's doing well, it's telling you that confidence is really building and things are looking pretty good. Now, I also wanted to point out the advanced decline line for the small caps. It has hit a new high. Now, this tends to be a leading indicator. This would tell me probably the small caps are going to hit a new high, but we're seeing a very big improvement in the advanced decline line. Now, on interest rates, just to kind of touch on the power index, we are seeing improvement there as well. You can see here, this is the 5-year Treasury yield is coming down, going into somewhat of a downtrend here, and the power index is still below zero. In fact, we're at a reading of a negative 4.4, which is very good. So it looks like to me that the interest rate story is starting to kind of stabilize. S&P 500 and the NASDAQ are the main trend. The primary trend is up. We're above the 200-day moving average. As you can see here, NASDAQ making a new high, S&P very close to making a new high, very positive. Now, this is kind of to show you the change of leadership that happens during a correction. So in other words, what's basically going on is human perception is changing. So here we have Delta Airlines. Now, who would have thought? Very strong uptrend, moving above that 10-day moving average. You've got the green on the trend meter, and both relative strengths are positive. So the airlines are starting to look strong. Louisiana Pacific, we're talking building materials. New high. You got a gap up on earnings, an ascending base, or an ascending flag, and a breakout above that flag. Good breakout on heavy volume. Trend meter's positive, both relative strengths are positive. This is very different from semiconductors and technology. Here's Southern Copper. I mean, this is a stock we do own. With all the demand, if one of the strongest groups out there is the electric utilities. And what's going on is with the proposed energy demand from artificial intelligence and electric cars, which I would put a question mark on. But you've got a nice base here and a breakout above that base. Trend meter's positive, relative strength is positive. So all in all, what I'm saying is things are looking a lot better. We believe the correction is pretty much over. However, it's going to be a different ball game than the first quarter. So if you have any questions, let me know.